Hello, I'm Nevin, and I'm an investment advisor at Pelican Wealth Advisors. Today, I will be going over the investment piece of the educational video series. All right, so what is investing? Is it speculating, saving? How do you define that? Investing is not speculating. It's sort of like saving, I guess you could say, but it's putting money away for long-term growth. It's not trading, and I think a lot of people may get that confused, or, investing versus trading, where you're in and out all the time, or, day trading and whatnot. Day trading is not investing. So investing is, having a planned and, this prepared approach to what you're trying to accomplish, what your long-term goal is. And the whole point of investing is, compounding. You're trying to get your money to grow compounding over time. One interesting little thing you can use when you're trying to figure out, what kind of interest rate you may need to grow your money over time or whatnot is the rule of 72. Take 72 divided by a rate of return, and that tells you how many years it would take to double your money. That's just a little thing, a little tool to use. The whole point is, trying to compound your money over time. Ideally, you don't want to be, pulling money out, withdrawing it and stuff like that. Next here is, of course, the sooner you start, the better. I'm one of those people where I wish somebody pounded this into my head when I was like 20 years old, so I, was putting money away then. But obviously, I think it's pretty common sense. Just the sooner you start saving and investing, the more time you have until retirement, or maybe you don't plan on retiring, but you're going to start working less, so you'll need some kind of savings or pool of money somewhere to be pulling from. So, the sooner the better. And playing catch up, if you get started off later on, playing catch up can be, difficult, and it can be dangerous. You may feel pressured to be taking, extra risks that, may not be appropriate, and you can get hurt in the long run there. Just keep in mind, the sooner the better, even if it's a little bit. When you're starting off, it's better than nothing. So when you're talking about investing, you need to be thinking about, your time horizon, how much time do you have? Because that will help determine, the kind of risk that you should be taking. And, and your goals, what is this money for? If you're in your 30s, 40s, or 50s, and you're not going to be needing this money for, 20, 30 years or something like that, then we'll say your time horizon, you got a long-term time horizon, and you're young. So you can afford to take some more risk for higher growth potential. So you just need to be aware of that you need to differentiate your investments between their goals and the time horizons. If you're, investing some money for a short period of time, you're going to want to put it into lower risk investments, like maybe bonds or something like that, that's paying some interest, versus stocks that, it could drop quickly for some reason, and then you need your money and it's not there. That's very important with this, is the goal and the time horizon for the money. Maybe you have one account that's retirement account, an IRA, or another side account that is specifically earmarked for retirement. So that one is, in all stocks, or, various kinds of funds for long-term growth that you're not going to touch. So that's something to keep in mind here and understand, or take note of. Next is risk tolerance. Well, this is very key, because you want to be absolutely sure you're not getting into something that you regret because you couldn't handle, the volatility or the ups and downs, and the potential swings of the market that could occur. Risk tolerance is really about the ability of the investment plan and yourself to absorb losses or fluctuations and volatility. So you need to establish whether or not you're conservative or moderate or aggressive. And, there's tools for doing that. And we have some really neat software that helps determine that we like to use. Not saying that that's an absolute must to use that, but, there's software out there that can help you do that. What we're looking at here is, you'll see, we're just trying to illustrate the risk versus potential return with the various types of investments that are out there. So, if you're just starting in the bottom left corner here, that's the lowest amount of risk, the least risky. type of investments, and those would be things like your treasury bills or treasury bonds, which are backed by the the United States government. Even if it's some foreign company, it could be foreign sovereign bonds. CDs would be next up on the list as least risky. Then you've got other various government bonds, could be domestic, or outside of the US. There's even emerging market bonds that are out there. So that would be a little bit higher up on the risk spectrum. Then you got your corporate bonds that are another step up. Those could be domestic or foreign. Then there's preferred stock, which is considered a fixed income type of investment because it pays higher than average dividend. And then you've got your common stock, which is pretty much what I would say the general population is most familiar with. When people are talking about shares of Apple or Microsoft or Uber or Google or whatever, they're pretty much always talking about the common stock. And then some of the most risky stuff out there, which, we're not gonna, probably won't hear it from this point on, but there's options and futures, and those are derivatives that, that are out there that we're not even gonna hit on, but those are the most risky things that you can do. All right, so types of investments. So you got your, cash investments and cash alternatives. So that would be like CDs at the bank, because that's protected by the FDIC insurance. You've got money market funds that could be cash alternative. They pay a small, low interest rate. And then there's your fixed income type of investments, which fall under the bond category. You've got your stocks, like I mentioned. And then there's, mutual funds. There could be stock mutual funds, or there could be bond mutual funds. And then you've got your ETFs, which stands for exchange traded funds. Those are essentially a basket of stocks in there. They're very similar to mutual funds. You can buy or sell them anytime during the day, and mutual funds only at 4 o'clock. And then you've got what's called your alternative investments, like maybe physical gold bullion, or, silver, real estate, maybe even like REITs are alternatives. So that's kind of the spectrum of investments that are available out there. So then inside your 401ks, you might have mutual funds or ETFs. All right, so touching on cash alternatives here, I think I already talked about that. It's basically they're low risk, very short term, and they're typically relatively liquid. Except for your CD, you're going to leave that in there until maturity, or theoretically you are. So that just includes your CDs, money market accounts, money market mutual funds, and and treasury bills. And they're the lowest risk. The advantages is there's predictable interest rates. They're very liquid, and there's very little risk to your principal there. But some of the disadvantages of these types of things is you're essentially losing purchasing power every year by just having a low interest rate like that. There's low returns. You can't really expect any capital appreciation or anything like that. Pretty boring, I guess, is the way to say it. But it's very safe. The next thing would be your bonds. When we're stepping up on the risk spectrum. So those, like I believe I mentioned before, they could be government or corporate, and they could be domestic or foreign. They pay interest, paid, in regular intervals. It could be monthly, it could be quarterly, it could be semi-annually. You got to look at those things, and it's different for every different, bond out there, or bond mutual fund that's out there, or even the bond ETFs, because there's bond ETFs that are out there. So, and the value fluctuates, and these would be interest rate sensitive, which means that they will, as interest rates move, they will move, and they move in the inverse direction of interest rates. So if interest rates are rising, then you can expect the value of your bonds to go down. And the reason for that is, if you think about it, why would anybody want to buy a bond that you have that's paying a lower interest rate than a new one that's being issued at a higher interest rate? The one that has the lower rate is obviously less attractive. So that's why that works like that. And still on bonds, talked about this a little bit. There's your government bonds. that are issued by the US government. It could be UK, your German bonds, for example. And then there's municipal bonds that, could be issued from, the city you live in. And then there's corporate bonds. And then there's agency bonds, which, could be like government agency bonds, like Freddie Mac bonds, Fannie Mae bonds, things like that. Summing up the bonds here, some of the advantages of them is that, typically they're steady and predictable stream of income because, like I said, they're supposed to pay you interest on a regular schedule. That interest that you receive is generally higher than the cash alternatives that we covered. And they are typically a lower risk alternative when compared to stocks. Bonds have a low correlation to the stock market. Usually when people are looking for safety, they go to bonds. Cash or bonds is where they go. The disadvantages of the bonds is that there's interest rate risk. You have default risk, so there's credit risk and interest rate risk. Those are the main things. One of a very general rule of thumb is that the lower your risk, the lower your return is going to be. So that's how this works. The safer you want to be, you're going to have to accept lower interest rate. If you're willing to accept more risk, then you're going to get paid more for accepting that risk. So that's how that works. Okay, so that concludes part 1. I hope you enjoyed that. And I will see you on part 2 for investments, where I'll be covering ETFs, mutual funds, and stock. All right, hope this was useful. Take care, and thanks for watching.